Okay, so here we go. My name is Myra Cisse. I want to thank you for joining us here at the Government Contractors Association. I have my colleague here, Richard Brooks, with the VP of Finance here at the Government Contractors Association. And we're going to be talking about creative funding options for government contractors. So Richard, and he's going to be introducing himself during the slide presentation. So go ahead and take it away.
Will do. Thanks, Myra. Good morning, everyone. As Myra said, my name is Richard Brooks, and I am here to give you a presentation on creative funding options in government contracting. And I think we have a lot to get through, so I'm not going to delay. Just moving on. If anyone has a question, please raise your hand, and Myra will be able to alert me, and we can address your questions. So who am I? All right, there we go. So who am I? My name is, again, Richard Brooks, and I'm an alternative funding specialist, a commercial finance broker. And what I do is I help businesses find funding, whether it be operating capital, whether it be for commercial mortgages or anything like that. I even have a few equity investors available. But I've been doing commercial funding for the last 6 to 7 years, and I have a lot of contacts, private lenders that I work with, and I use those to serve our clients here within GCA. I went to University of Michigan, got my MBA in Finance and Corporate Strategy. I own Progenics Financial Group, and I funded over $1 million to small businesses in my first year as a commercial finance broker, and things have been going pretty well since then. Just getting started. So what are we talking about? We're talking about how are you going to fund your business. And a lot of people, well, I won't say a lot of people, but some people, they have the money in pocket. They break that piggy bank and use what's in there for whatever they need. But for those of us who aren't quite as blessed, we have to look for alternative solutions. Now again, what I'm focusing on is funding your business. So if I won't be talking anything, I won't be talking about anything to do with personal mortgages or anything to fund your personal life. This is all about your business, and in particular, your government contracting space. So I'd like to just start by asking you a question. What are some things you'd like me to touch on as I go through this presentation? If you could just, I don't know if Myra, should they speak? Raise your hand and let me know if you have a comment or something.
No comment?
Okay. Okay. Well, then I'll proceed. And again, if you have any questions as we go, please let me know. So if you had a contract come your way, do you have the funds to get started? You have to keep in mind that you don't get funds up front. You typically have to work your contract for at least 15 to 30 days before you can generate an invoice. And then the government takes 10 to 30 days to pay on your invoice. So we're talking about that period in between starting the contract and getting your first payment from the government. Do you have the money for the materials and supplies, the for payroll, to secure equipment, insurance, or bonding that you need to deliver on your contract. And as far as different sources, runaway computer. Okay, what's going on? All right, so there are different sources out there, and you pay different prices for whatever the source is, and it generally goes according to the riskiness of the type of funding being provided. If you go to a bank, you can typically get lower rates, but you have to provide, in most cases, collateral, which makes it a little bit less risky for the bank. And even still, if you have all the collateral, sometimes it's still tough to qualify for that traditional funding. Maybe you're planning to use your credit cards to fund your business until you can get things going or get payments coming in from your contract. This is well and good, and credit cards go a long way, but they have limited usage. They have strict limits, and in the meantime, on those credit cards and everything. So, and the advice you need to that cash you may need for things for people that don't take credit cards. Personal loans. You typically need a pretty strong credit score for personal loans, and if this is something that fits you, I suggest you evaluate using that. But most people try to separate their personal life from their business life, and I think if you can, you should. And then there are things like factoring and invoice that you can have financed. This is actually an alternative. Friends and family, a rich Uncle Joe who just loves you and wants to see you do the best you can and is willing to fund your business. Also, another alternative strategy is hard money. I mentioned factoring and hard money here because a lot of people are familiar with those, and I think they know about them, and maybe they have heard a few things about them, aren't sure about them, but we will get into them a little bit more as we go. As for hard money, just keep in mind that hard money typically requires collateral, similar to a bank, and it's just a lot more expensive than a bank traditionally is. The one thing I'd like to point out is that GCA can help. Again, I've been a commercial finance broker for the last 6 to 7 years, and have lots of contacts who provide funding for different purposes for businesses. These lenders operate outside of the banking environment. Their funding options are considered alternative, and we also have access to the mobilization fund, a mobilization fund through GovBridge Capital. A little bit later. I understand we have a question.
We do. Yes, are you able to hear me? Okay, great. So the question is back on the previous slide when you talked about hard money. You mentioned hard money also requires collateral, but it's just a lot more expensive than the bank. So in what context would hard money versus bank money?
I think when you start looking at any type of debt product, you have to use it strategically. It depends on what return you're looking to get on the money borrowed, because you're not just looking for a profit based upon the project. You have to look for profit once you pay back the money you used to get started on that project. So I think in any case, when you're looking at debt, as long as you can justify, you can still achieve a return on your investment, your full investment, even considering the cost of capital, then I think you can consider that. But again, with hard money, typically they are looking for something that has a guaranteed value, say like real estate. They can go out in the market and evaluate what a particular piece of property is worth, and they will, and even then they're not looking to give you the full value of that as a loan. It might be 80% of that value. So they're hedging their bets as far as if something happened to you today and they end up owning that property, can they cash it out somehow to recoup the funds that they gave you? So that's what it's all about when someone is looking at collateral. It's hedging their bets for the worst case scenario, that you're unable to pay them back. Did I answer your question?
Yeah.
Okay, great, thank you. So again, GCA can help in all types of situations, and we're just talking about a few of them today. And the funding world changes and evolves over time. So different lending options come available as time progresses, and I tend to keep my finger on the pulse of what's going on, and I'm adding lenders on a regular basis. So here are some typical alternative financing options, and you may have heard about a few of these. Again, we talked about accounts receivable financing and factoring. There's also equipment leasing, unsecured business lines of credit or credit card type deals. We have business loans, and I'll go into that a little bit. I'll go into all of these actually. And then we have trade financing. And some of these you can actually get from a bank these days, but it hasn't been the case, and a lot of banks are taking on alternative financing type portfolios. So for the first one I'll talk about is accounts receivable financing and factoring. Now, it is a $2 billion industry and one of the largest in the alternative financing space. And it uses accounts receivables as the collateral for any line of credit or loan that someone issues you. When it comes to this, obviously, you have to have an ongoing business, one that's generating invoices, and actually is not just generating invoices, it's knowing what the payment history is like on those invoices. In many cases, okay, what happened? My computer's possessed. It keeps changing on me. But in many cases, one of the first things a lender will want to see when they look to finance your invoice, first of all, what are the terms of that invoice, and then what is the typical, how long does it typically take for that particular client to pay on your invoice? This is typically reflected in an aging. It's an accounting statement that shows just that. You issued an invoice on this date, and the client paid for it on this date. Was that? If the terms are 30 days or net 30 or something like that, okay, they're looking to see whether or not the client paid within those terms. And if they went outside of those terms, then then they have to make considerations as to whether or not that's something they want to take on or how much they want to charge you for advancing against that invoice. It addresses a lack of capital by setting up a line of credit, at least in the case of AR financing, accounts receivable financing. Factoring can be based upon one particular invoice. Accounts receivable financing could be based upon a stream of invoices for a particular time with a particular client, or it could be based on your whole portfolio of invoices, all of your clients for a particular time. And different lenders provide different forms of AR financing. The typical client who uses AR financing and factoring is looking to expand operations and needs extra cash flow. They may be falling behind on payroll or taxes or paying their suppliers and general business expenses. And the reason being they've performed work and they're waiting for their clients to pay them. And so the lender helps them by giving them maybe 80, 85, 90% of their outstanding invoices. And the lender will collect from the clients the invoices and then first take care of whatever loan that they gave up front, any advance paid, and of course any fees involved. Typically, I've seen 1.5% for 30 days, up to 2.5% for 30 days, and it can go up beyond that depending on how risky the advance is based upon that particular client. One thing to keep in mind here is that when you start looking at qualifications for this type of financing, they're not looking at you as the borrower. They're looking at your end client because that's who the ultimate payment is coming from. It's not coming from you, it's coming from your client. So any type of due diligence will be done on your end client. There will be some limited due diligence done on you. Typically they're looking for whether or not anyone has a lien that can overstep their claim on any of your receivables. Say the IRS, maybe you have an IRS lien, or maybe you have some other type of situation like child support that could step in and take payments from you. So I think we have another question.
Yes. Okay, so this question is from Mary, and she was asking what type of, how detailed is the check that's being done on her client? You know, if she's doing factoring, and you said that the check isn't done on her because it's not her paying the invoice, right. It's her client. What type of check is that? Does she need to notify her client, etc.?
Typically, they're trying to evaluate how that client's doing with paying all of their payables. So there are different sources in the industry, like Dun & Bradstreet. That's the one most people know about. But there are several other sources that track payments from different companies and how they're doing with those payments to various vendors that may be serving them. So what they're trying to evaluate is what is the chance that this client will not pay them, and that if there's a small chance, they may take the risk and just charge you a little bit more for that risk. But if it's a company, say it's the government, with the government, they know that if you perform the work, the government will pay. So you tend to get favorable consideration when you have a government client versus whether or not you have a commercial client. The other thing they're doing, they're verifying that it's a real invoice. They want to make sure, be certain that you've done the work. They may call the client and ask, okay, is this invoice real? Have they performed this work before they issue you an advance? Further questions? Okay. So basically, if for those who may not have heard the question was how much due diligence is done on the end client. And if I've answered that question, I'll move on. Okay, moving on. So who typically uses this service? Again, it can be anyone that invoices. If you provide a service or product and you invoice for payment, no matter what terms there may be, you can use factoring. And again, the due diligence is mostly on your end client. So you see janitorial services, trucking companies, any type of subcontractor, telecommunications companies use this service, marketing companies. It really runs the gambit as to who can use this service. Next up is equipment leasing. And this is used by many corporations to acquire equipment. And the one thing to know is that this is not the same as leasing a car that you may be familiar with, you know. I've had the experience going to lease a car, and first thing they want this big, huge amount down up front, right? And then you're paying on this for however many months you've agreed to, and at the end of the deal, they're expecting you to turn the car over or at least pay a certain amount to compensate them for the car. Equipment leasing is a little bit different. It's a huge industry also, $500 to $600 billion industry. And at one point, most banks did not do equipment leasing. And as I mentioned earlier, you're starting to see a lot of alternative financing options creep into the banking arena because the banks realize that they have to do a few things differently to maintain a lending portfolio. But again, it's designed for the client to own equipment at the end of the lease. So whereas a car company is letting you pay for a portion of the car, here we're trying to arrange financing for you to pay to actually own the equipment at the end of the lease, no matter how many months you finance it for. It can be anywhere from 24 months to 60 months, but at the end of the lease you will have an option to buy it, either at dollar buyout or whatever the market value of that piece of equipment is at that time. The lender keeps the title to the leased equipment until all payments have been made. Now, why would someone want to lease versus loan? Well, leasing actually provides quite a few benefits that versus a loan. Whereas with a loan, you're required to put a down payment, there may not be a down payment required for a lease. Typically, what I've seen is that you're required to pay first and last month's payment, but all of that goes against your payments. There are no blanket liens. There's just a lien on the piece of equipment that you're buying. Whereas with the loan, they may put a blanket lien against your whole operations, all assets of the company, all receivables of the company, and anything else the company could claim as an asset. So look out for your kids. But the thing to keep in mind, when someone has a blanket loan on your company, that prevents you from readily doing other types of lending or borrowing for your company. So it limits what you can do going forward. And again, on the leasing side, they're typically only placing a lien on that piece of equipment. So say you're buying a Bobcat or something like that to use on a particular contract, the lien's on that Bobcat. It's not on any of your receivables. It's not on any other assets. There are no financial covenants involved with leasing. And on a loan, typically there are financial covenants, especially if you're using a bank. Now, on the leasing side, it limits your risk of obsolescence, meaning, okay, it limits your risk of obsolescence, meaning this piece of equipment goes, it has no further usefulness in the market or to you. That means the value of that piece of equipment on the market is significantly diminished, and you know, you can't use it yourself. Whereas because on the leasing side, because the lender still holds the title to that piece of equipment, they bear the risk of that obsolescence. Now, we have a question here, what are covenants? And I'm going to give Myra a chance to address that question. She's coming from a banking background. I don't know if you guys... So give us 1 second.
Yes. What covenants are in a loan is if you, let's say you have a line of credit at a bank for $100,000, there could very well be a covenant requiring that that line of credit be paid down to a zero balance at least once during a 12-month period in order to keep the line of credit active. So it's just a condition that's placed on a loan in order for you to continue having that loan or line of credit in place. That's a nutshell version of that, but I'll let you proceed.
Okay. Well, thank you, Myra. Okay. Now, a key benefit of leasing is that all of your payments are tax deductible, as long as it's a real lease. And whereas on a loan, a loan is only partially tax deductible, typically limited to the interest that you pay. Also, one last benefit of a lease is that it does not affect your available credit. A lot of the alternative financing options are actually off balance sheet or something that do not show up on your balance sheets. It's off-book financing. So depending on what type of due diligence your next lender uses, they may not even know about your lease and won't even consider it. Equipment you can fund. All types of things can be funded through leasing. Restaurant equipment, computer systems, phone systems, vehicles actually. Vending means diagnostic equipment for medical offices, dry cleaning equipment. It runs the gambit. But the one thing to keep in mind, it'll be easier to find a lease on a piece of equipment that has a readily establishable market value. Say that someone wants to lease a truck, a dump truck. It's easy to find a lease on a dump truck because there are several markets where someone can go to establish a current value on a dump truck based upon its age, based upon the number of miles it may have. Whereas, say someone wanted to lease, let's say an X-ray machine. It's not as widely used, but you may have to go to a specific place to establish a value for it. So I hope that example conveys what I'm trying to convey here. Let's say fitness equipment. It's hard to establish a value for fitness equipment. So there are specific lenders you have to go to find a lease on fitness equipment, and your qualification requirements may be higher to get that actual lease done. So the next option, unsecured business lines of credit. And this is an option that allows you to get business credit based upon your personal qualifications. So say you're a startup. You don't have any clients yet. You don't have a stream of revenue to show yet, but you need funding for your business. This is a way, if you have strong credit, strong qualifications personally, you can go out and get credit in the name of your business. And although they may pull your credit to evaluate your qualifications, the actual credit that you receive does not show up on your personal credit report. So it's in the name of your business. It doesn't show up on your credit. And in that way, it doesn't impact anything you need to do on a personal basis. Like say you're applying for a mortgage. They may see that you have an inquiry, but that's about it. They'll see the inquiry on your credit report, but they don't see the actual line of credits that are established. So there are no time and business requirements. You don't have to provide financials. You don't have to provide collateral, etc. But again, you just have to have good personal qualifications. This is used at the discretion of the business principal, meaning you can use the funds for any purpose. Again, it's great for business startups. I've helped a lot of franchise owners to acquire their franchises using business lines of credit, and it really helps with business expansion too. Then we have revenue-based loans. Now, something we'll talk about shortly is a merchant cash advance, which is also based upon your revenue. But these are typically less restrictive than banks, but not as easy as a merchant cash advance, as we'll talk about shortly. Loans based upon historical sales that can typically close in 5 to 7 days, but they do require at least 2 years' time in business. The credit requirements aren't quite as restrictive as, say, the unsecured line of business credit. You can start looking at a revenue-based loan if you have credit starting at 600 and going. Typically, they want to establish that you don't have any liens or collections or anything like that. So, so it's a little bit easier to get into than, say, going to a bank. Again, we're talking about private institutions, private lenders that provide these. And rates start at around 12%. Now let's talk about the merchant cash advance or business loans. Again, these two are based upon historical sales. But the payback method tends to come directly from your bank account via ACH. You can do daily payback at the end of the day or weekly payback. And here we're talking about business days, so it's Monday through Friday typically. And this is a great option for people who can't go to a bank due to credit requirements or something like that, or maybe they have a lot of loans and they're just trying to keep things going. You see a lot of restaurants use this because of the riskiness of that industry. This is one of the key sources of financing for restaurants. They typically evaluate 3 to 4 months of your bank statements, and I just got a comment here, banks hate restaurants. They typically look at bank statements for 3 to 4 months and evaluate what your revenue stream is like, and they will advance a percentage of that revenue stream based upon what they think you can pay back within a certain amount of time. The rates on these types of loans can be very significant. I've seen them start at 18%, and if you can find one of these at 18%, you're doing pretty well. I've seen them as high as 45 to 50%. And how can they get away with that? They don't call it interest. It's called a fee, basically. And they can't call it interest because they don't know how much time it's going to take for them to recoup the loan, because they're recouping it based upon what you can pay on a particular say, I'll put it this way. Say they evaluate and you've been generating $10,000 to $15,000 per month in revenue. They advance you, say, 3 months worth of that. So they advance you $30,000. Now, what if your business starts to suffer and all of a sudden you're doing $5,000 to $10,000? Then you can't pay back the funds at the same pace that you were doing it, or as they anticipated. So they can't guarantee themselves that they're going to pay you back, because you may even go out of business within the time frame. So this is considered a really risky loan, and they can't say how long it's going to take for them to get paid back. So they don't call it interest. It's basically a fee. You pay the same amount back no matter how long it takes. So if it takes you 3 months, fine. If it takes you 5 months, then they lost out. You did better. It's been interesting. I've gotten these types of loans for some clients in the past, and they ask, so if I pay it off early? And my question to them is, why would you want to pay it off early? That just means you pay a little bit more. Time is on your side, I'll put it that way. Okay, moving on. So trade financing. Trade financing is typically used with businesses that are purchasing product or goods sight unseen. And they may want someone to wherever it is. Take delivery of it. It's well qualified. Again, it's based upon an order. The merchant on that. So, all right. So again, we're talking about trade financing. Sorry about that issue. We're back now. Trade financing is used to fund sales orders from well-qualified companies. Again, you have to have a purchase order in order to use trade financing. It provides letters of credit to foreign or domestic manufacturers for the cost of pre-sold finished product. So basically they're saying if this product it meets the qualifications that the customer is requiring, then they will guarantee payment. So what you might have is a manufacturer who's saying, okay, I don't want to get started to produce this product because it costs us money to do that. And then on the other side, you have a client that says, I don't want to give you money up front to produce this product because I don't know what it's going to look like, and I don't want to be left holding the bag either. So you have an intermediary to come in and facilitate that relationship. They say, if you produce the product according to my client's qualifications, we will guarantee payment for you producing that product. It could include product inspection anywhere around the world to guarantee the quality and adherence to the client's purchase order specifications. So, and for the client, they don't have to pay the intermediary until they are paid. So typically you see purchase order financiers work with a factoring company on the back end to do the actual collection from the end client, the person who submitted the purchase order. So here's an example. The client receives a $250,000 purchase order for finished product. The client issues a PO to the vendor to fulfill the order. The vendor requires the letter of credit before manufacturing or shipping the product. The lender provides the letter of credit on behalf of the client. The product is then manufactured and inspected. The product is then shipped, and the vendor draws on the letter of credit for payment. The title to the product is transferred to the client's end customer. The client issues an invoice to that customer. The lender is repaid by the client's bank or other working capital source, typically a factor, as I said. At that point, the bank is paid, and the factor also takes their small percentage, and the rest of it goes to whoever received the purchase order to begin with, the client. We have any questions about that? About anything?
We do have one question from.
Okay.
Okay, so mainly. Okay, so I'm just confused as to when the letter of credit is repaid in the previous example.
Okay.
Because I got you up to the product is manufactured and inspected, and then I got lost when yeah.
Okay, so the product is manufactured and inspected. The product is shipped to the end client. The vendor draws on the letter of credit. So whoever the manufacturer is, they can then take their payment based upon the letter of credit. The title to the product is transferred to the client's customer. The client can then issue an invoice. Now, again, the purchase order financier, the one issuing the letter of credit, will be working with the factorer. All right, the factorer will then advance on that invoice to pay back the letter of credit. All right, then so the lender, the factorer is then repaid by the client's bank. The lender being the factorer in the last bullet point. Okay, and then the factorer will take out their small percentage, their small fee, and give the rest of the funds to the client. Thank you for that question. Help me clarify that. Okay. So do we have any other questions before I move forward? Okay. So we do have a question.
Charlotte, do you have a question?
Charlotte, do you have a question?
So far you guys are sounding pretty good. It's just that as you develop the workshop, you're breaking up, and it's kind of in between. I understand what you're actually saying, but with the ability to read it, I'm listening half and reading more. So if you guys can straighten that part out, I might have a question or two down the line.
Okay. I understand. I understand. We'll try to straighten that out as we go. All right. So what I want to do at this point is talk about when to use debt. We kind of went into it at the top of the presentation, that when you use debt, you want to make sure that you're still getting a good return on your investment, even when you factor in your cost of capital. So I want to go through an example with you guys, and I want you to tell me what you think. Let's say you have a contractor that borrows $100,000 to start a contract that was going to earn him $1 million in his first year with 4 option years. He's borrowing the money to take care of insurance and payroll for 4 months. You have to pay back $200,000 using contract proceeds over that 4-month period. So if you were to calculate an interest rate, that's like 100% interest, right? So here's my question to you. Was the $100,000 a good debt or a bad debt? So what do you guys think? Raise your hand if you'd like to comment. No hands? Okay, how about this? Would everyone type an answer to let us know what you think? Was this good or bad debt? Any takers?
No takers.
No takers.
I said good debt.
You said good debt. Okay.
Oh, wait. Ron is a gray soul.
Ron. awesome. So what does Ron say?
Oh, and we had a couple of them. Charlotte. Okay, so Charlotte said bad. It was $200,000. Ron said good. Okay, and this is only two brave souls. So we're going to.
So Ron, did you say it was good? Are you there, Ron?
Can you hear me?
Yeah.
Yeah, I can hear you now.
Oh, you hear me?
You said it
Okay.
was good. I can hear you now. So why did you say it was good there?
Because he borrowed $100,000 to start the contract, with the earning for $1 million for the first year, and with the option of 4 years. So, so out of that, he had to pay back $200,000 due to the contract proceedings of 100% interest. He's gonna make that back. So I say it was good because he's able to have that option, the 4-year option, and to make his payroll, you know, within that time period that he needed the money.
Right.
So he's gonna to float the business. It was a good business decision because he's got a contract, you know, that's got potential earn of $1 million with the option for four years. So
Exactly. So he could potentially, from a revenue perspective, he's still looking at, what's that, $3.8 million coming to him, and all he had to spend was $100,000 to get it. I would do that deal. Charlotte, why wouldn't you do that deal? Is Charlotte unmuted?
Yes, I'm here. As a contractor, it just depends on the actual project itself. Because
Okay.
like it states, yes, you're starting up with 100,000, so you're going in on a hope, you know, and grant you have the option of the 4 years, but it's not a guarantee. And within 4 months, you are automatically 200,000 in debt. You understand?
So let's say you only have it for a year.
Okay.
So does that make it a bad investment for you?
Well, not if you look at it. Okay, you're going to reap the benefits of the 800,000. You know, then yes, you would take that gamble and per se, borrow the 100, give back 100. You know, that's an even flow. Okay, I appreciate you, and you still have 800 good. You know, but the 4-year option, it's not a guarantee. You understand? Anything is subject to happen within a year's time. So it's just a CYA on a contractor practice.
Right. Now, mind you, this is an oversimplified example, and it's an extreme example. I mean, you don't expect to pay 100% on any type of loan. But, I mean, if that was your only option, say you had a rich uncle and he wasn't giving you the money, he was going to charge you for giving you the money, would you not do it? This was your only option to get this contract going. Would you not take the loan?
Well, yes, once again, it just depends on the actual. I would probably so take and invest and have someone to invest in me. But me as the contractor, I would have to weigh the pros and cons of the whole scenario, you know, whether I would go ahead and bid and take or decline. You understand? It just depends.
Okay. So those are definitely options. And I guess if I'm looking at the costs, I guess it's an oversimplification, like I said, because you don't know exactly what your margins are on this contract. Now, if your margins are low on this contract, maybe it's not something you consider. But if you are actually making the $1 million in your first year earnings, then I think it's something you have to consider doing. And I think when it comes to using debt, this is the way you have to evaluate it. What is it going to cost me, and what am I making using these funds? If I'm only say I'm only making $100,000 within this first year, and I'm paying $100,000, that means I've basically broken even, right? And you're counting on the next 4 years to make you whole, or to really make you profitable on this contract. So you're buying into it, saying that, okay, maybe this first year I'm not going to make any money, but the next 4 years I'll make $100,000 each year, or something like that. And you have to evaluate whether or not it's worth that risk for you, because as Charlotte's saying, okay, those next 4 years aren't guaranteed. They're option years. So you do have to weigh those types of decisions. Now, the other thing is you have to know whether or not you can perform on this particular contract. If it comes down to your performance on the contract that you're questioning, then you really have to make a judgment, because you're the only one who can do that. So we have to start winding this down. So I'm going to move a little bit quickly through this. We talked a little bit, there are commercial bank loans out there, and you guys are probably familiar with what it costs and how to go about getting those. You go to a bank, all right, and they have different types of options: short-term, medium-term loans, and medium to long-term loans, and then there's real estate financing. Asset-based lenders provide a variety of financial services to small, medium, large businesses. Typically, we're looking at secured lending against the assets of a corporation, whether or not that's an invoice, whether or not that's a piece of equipment or real estate or a purchase order. You know, that's what it's about. They're looking for different types of collateral to use to help you do business. Another solution that GCA has access to is mobilization funding through GovBridge Capital. And this is a customized solution for government contractors. What exactly is it? It is funding for the early stages of your contract. So what we are able to do is to provide funding to help you get started on a contract. It doesn't require that you have the invoice as your collateral. And you will see that you can't use a factoring company for early stage financing because you don't have an invoice yet. And there is no collateral for this type of funding until you perform some type of work, after which you can generate an invoice. Only then is there collateral. Lack of funding is a barrier for many small businesses getting into government contracting, and a tool that GCA is providing to help its members to move forward with their businesses and expand in the government space. GCA members will actually receive favorable consideration and rates due to their involvement in GCA trainings. What is mobilization funding? It's asset-based financing alternative. It's specialized, more flexible from an underwriting perspective, and it's actually short-term debt. The loans are established to help you get started on your contract, and once the invoice payments are coming in, you pay off the loan, and then you're established by those invoice payments so that you can carry on the contract without any additional funding. Or in some cases there may be additional funding required, and then we can pair you up with a factoring company to take care of that. It's like early stage financing, and it's like equity financing without promising someone a share of your company. which is a good thing, because when you promise someone a share of your company, that's pretty much the most expensive financing you can provide, you can secure. How is mobilization different? Again, it provides funding before service begins. It's similar to purchase order funding, specifically for government contracts. It can be used for federal, state, city, local, municipality contracts, and loans are available from $10,000 up to $2 million, depending on the contract terms. Typically, we're evaluating what 1 year of a contract is worth from a revenue perspective, and we're able to work loans out around 25% of that amount. So how can you use these funds? These funds are geared towards contract-related expenses only. So you can make payroll, insurance, purchase materials, or any other specific contract-related expenditure. It's not for non-project related expenditures. It can't be used to pay your car note while you're waiting on your first invoice or anything like that. In fact, what we do in the beginning stages of your loan is establish who your vendors are that need to be paid for what expenditures and when they need to be paid. We come up with a schedule of payments, and we take care of those as according to the schedule that we agree on upon funding. Should you need other funding options outside of the scope of your project, again, we're here to help you with that as well. How to qualify? There is a way to get pre-qualified for this type of funding. Basically, it allows us to do our due diligence with you. And then when you get a contract, we do our due diligence on the contract and come up with a funding schedule as to when we need to take care of paying what vendors and for what, again. How long to get funded? It can be as quick as 1 to 3 business days for those who have been pre-qualified. Again, once you've been pre-qualified, you just need to evaluate your contract. How much can you borrow? Again, the loans are from $10,000 to $2 million and up to 20 to 25% of the yearly contract value. Structure of contract payments will factor into how much can be borrowed due to the short-term nature of the mobilization loan. What terms are offered? Short-term debt, again, 3 to 4 months to help you establish your contract. And rates vary based upon the strength of your company, but you can expect something in the range of 4 to 5% per month that the loan is outstanding. Closing fees are about 5% for GCA members, and this allows us to do the due diligence, and then there's an admin fee for the administration of the payments to your vendors. The admin fee is $200 per month. Generally there is no personal guarantee required unless we feel that there's some certain things that in your credit history that may jeopardize the loan, then we may require a personal guarantee. A personal guarantee may also be required for companies that are new to contracting and have never delivered on a contract. Personal collateral, your contract is your collateral. So whereas there are no blanket liens, but there would be a lien put on the receivables of this particular contract. 4 steps to get funded: get pre-qualified, submit a full application, and get pre-approved for funding. Once you get a contract, you can be fully approved, and again, funding can take place in 1 to 3 business days. And I talked about this already, the funding schedule is key, coming up with exactly what needs to be funded for your particular contract. So if you're ready to expand in the government space, you can get more information about the mobilization funding at www.mobilizationfund.com, and you can get more information about GCA's offerings at www.govassociation.org. So now I'll open it up for any last questions. We're about 5 minutes over, so we thank you for bearing with us. We hope this has been beneficial for you. If you have any questions, Charlotte?
Yes, I do appreciate you taking out the time to enlighten me with the knowledge. Yes, can you hear me? Can you hear me?
Yes, I can. Thank you.
Okay. Okay.
Yes,
thanks.
I can.
Okay, I just wanted to say I appreciate you taking out the time to give me the knowledge. I have gained quite a bit of this course here today. Now, my question is mentorship. Are there availabilities? I have pursued since 2007 with the SAMs and registering with them and trying to get the I dotted and T crossed accurately. And so that's why when you asked me the question if it was a bad or good, at this time, you know, I'm in questioning of stability as far as making sure the I is dotted and T crossed. So is there a webinar that you guys will perform, or is there a mentorship that you guys have available, or just read off of this mobilization and government to answer some questions?
Yeah, Charlotte, I'm going to answer your question again. This is Myra. We do have coaching programs here. I'm not sure if you're in the Atlanta area or not. Where are you located?
I'm in Laurel, Mississippi.
Okay. So you have coaching programs available. Some of those are offered virtually. For the members of the association, every Tuesday we do a training here at the office that we record and make available for our members that are out of state. So if you're looking for like mentorship or training, then you can get that detailed attention by starting off with membership at GCA and then attending the trainings that we do relating to everything from start to finish, from how to get properly registered in those registration systems, how to gain your certifications, how to find contracts, you know, how to properly write proposals. We've got an upcoming proposal boot camp, so we've got pretty much everything within the organization that helps you get from the point of where you are to being a successful government contractor. So if you'd like to, I can talk to you offline. If you don't mind, you know, hitting the question bar again and asking questions, I can give you my contact details, and then that way we can talk after the webinar, okay?
Okay.
Awesome, thank you. And we've got another question.
Okay, and we have another question from, okay, I guess they changed their mind on that. So lastly, I'd like to point out, as Mara was saying, we have a lot of coaching and training and services for government contractors. We aim to be your first stop when it comes to government contracting information. We coach on obtaining contracts. We coach and provide services. We can help you maintain your contract. If you don't remain in compliance on your contract, you can lose it as quickly as you received it. So we do provide a lot of services for government contractors, and if you need anything from us, please feel free to contact us via one of our websites. You can join us at govmarket.net, and you can find a list of our events at govevent.com. If there's anything else we can do for you, please feel free to contact us. Thank you for attending the webinar.